Having a deep interest in all things finance, I love watching the crypto space rise, fall, and rise again and again. Now we're seeing one of the largest, sharpest, and most dramatic declines in crypto history, and we're not even talking about altcoins. So how do you safely invest in a growing but volatile market? Today, I want to talk about how one company keeps your digital money warm during this crypto winter. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. In 2012, 29-year-old Brian Armstrong and 24-year-old Fred Eshram pitched their brand new Bitcoin wallet and exchange on Y Combinator. After receiving $150,000 in funding, the newly named Coinbase was ready to change the face of crypto. Armstrong's original pitch deck includes some interesting facts about the company, like the near immediate adoption of the platform, with thousands of signups and tens of thousands of dollars of Bitcoin being traded in just the first few weeks. Coinbase was off to a flying start. Growth continued to compound, and Coinbase reached over 1 million users just 2 years after debuting online. However, the startup faced issues early on despite this immediate success. Hackers broke in and managed to make off with more than 250,000 Bitcoins. A few months after that, Coinbase's primary bank abruptly cut the platform off from funding, yet still the company managed to truck along, continuing to build out its platform. However, one problem would threaten to shut down Coinbase for good. In 2014, Bitcoin peaked at an all-time high price of $1,100 per coin. Nothing could stop the mass adoption of cryptocurrency, or so it seemed. 2014 ushered in one of the roughest years for Bitcoin maxis. Prices shot out throughout 2013, but suddenly in February 2014, the institution handling 70% of all Bitcoin transactions, Mt. Gox, abruptly suspended all Bitcoin transactions. Over 500,000 Bitcoins suddenly vanished, plummeting the price of the crypto to $150 or less, a 90% fall. This sort of pattern became a recurring theme in the crypto world. Whenever the proto-currency started to see mass adoption, suddenly something major went wrong and prices would fall dramatically. 2014 isn't the only time to be referred to as the crypto winter. In 2018, something similar happened. Bitcoin again amassed adoption on a massive scale, reaching thousands only to have it all ripped away by a series of unfortunate events. South Korea planned to ban Bitcoin, Coincheck gets hacked, and with hundreds of millions of dollars stolen, Binance develops issues, and cryptocurrency advertising gets banned by major online advertising companies. Bitcoin again falls 75% in price, and a bunch of other currencies go to zero, because when it rains, it pours. Through all this unfolding drama, Coinbase remained relentless in the pursuit of building the best platform for all of crypto. With Coinbase Wallet and Coinbase Ventures, the company expanded its product offering and started to invest in the best upcoming crypto-focused companies. It wouldn't be until 2020 that Coinbase would really ramp up production. As circumstances left people cooped up at home, mass adoption of crypto started once again. With this boon, Coinbase rapidly built out its business both through acquisitions and in-house development. All of this culminated in the company going public in the middle of 2021. Yet the timing proved to be unfortunate. Just months after the company went public, Bitcoin peaked at $64,000 per coin, with Ethereum and Solana also reaching all-time highs. Since then, they've had serious haircuts in terms of price, including Terra Luna and USDD going to zero. These stablecoins, cryptos often used by investors to earn a safer income from investments, have gone to zero. Now we're in yet another crypto winter. Maybe this one could be attributed to the Federal Reserve's monetary tightening, leading to the end of the so-called era of easy money. With times getting tougher, cryptos have had a harder time getting off the ground. Even many of the larger tokens have seen massive withdrawals. So where does this leave Coinbase? Will it be able to survive this cold spell in the crypto market and continue to build the future of the crypto ecosystem? Let's examine Coinbase's financial health to get an idea if the company is prepared to battle the freezing temperatures of the market. Given that Coinbase has only been public for a year or so, we only have 3 years of financial data to go off of. Still, it's clear that over the last year, Coinbase saw an explosion in activity resulting in much higher revenues. I expect that revenue will begin to fall as we go through 2020, but we'll see. Unfortunately, shares outstanding is pretty hard to gauge given that the company has has been public for only 1 year. However, Coinbase has increased its shares outstanding by about 10%. Like many of its tech counterparts, Coinbase is diluting shareholders. Moving on, we have free cash flow. Surprisingly, Coinbase has had free cash flow over the last 2 years. I guess it couldn't burn the overwhelming amount of cash that it had coming in that quickly. Note though that in 2019, its free cash flow was negative. I fully expect the company to return to unprofitability soon, potentially even by the end of the year. Another important metric to examine is Coinbase's return on the capital reinvested back into the business. Last year, that number stood at a whopping 22%. Of course, this is the only public year, so we really only have that one point of reference for ROIC, but nonetheless impressive. While ROIC is solid, debts are a different story altogether. With nearly $21 billion in total assets, $6.3 billion of which is cash, Coinbase boasts over $14 billion in total debt. This is made worse when you factor in that nearly $11 billion of this is due in just 1 year. While Coinbase has enough current assets to cover these debts, I'll still want to keep a close eye on this. And finally, as expected, Coinbase does not pay and has never paid anything in dividends. Altogether on the surface, it appears that Coinbase is mostly stable, and to a degree, I would agree. However, most of the stability comes from the mass adoption of the larger cryptos like Bitcoin, and that's because the vast majority of Coinbase's revenue comes from charging fees on these crypto trades. So let's take a step back and revisit the idea of owning cryptos for just a few minutes. A number of months back, I made a video on why I am not a Bitcoin investor, despite the fact that I believe that the core functionality of the project is a pretty cool idea. Since that video though, I've learned a lot more not only about Bitcoin but many of the other cryptos and their supposed uses. From NFTs to smart contracts and the whole DeFi space in general, I now have a simpler problem with it all. Crypto's fundamental problem is fragility. From incessant tweeting by oligarchical billionaire causing the market cap to move by billions of dollars, to a large institution shutting down and causing a massive crypto crash, and of course the ever-looming potential of nations to outright ban the major cryptos, it seems like there's always some sort of crisis going on. And it's with this lens that I view Coinbase, an asset with tangible value that it could one day return to investors, a company that allows investors to avoid altcoins crashing 90%, but most importantly as something that'll continue growing as the general crypto space does. So let's dive into the business behind the brand so we can see if Coinbase could be the best path for crypto exposure during yet another great crypto winter. To begin, I want to emphasize how Coinbase actually makes money. Coinbase operates across many dimensions of the crypto space. As I said, the most important dimension is actual crypto trading. The fees range anywhere from 0.02% all the way up to 0.6% of the total transaction. Naturally, most of its revenue comes from non-institutional traders. These quote-unquote retail traders make up the vast majority of Coinbase's trading revenue. This makes sense as institutions often trade a lot less and have bigger trade sizes overall. While institutions make up the vast majority of total volume traded, it's really the retail traders where Coinbase makes all its money. So long as cryptocurrencies on the whole can continue this mass adoption and Coinbase continues to grow, its user base and therefore revenue will likely march much higher. Because at the end of the day, Coinbase should really be focused on growing this user base, especially retail traders. And if you want to help grow the user base of this channel, sub and like below. Some of the ways that Coinbase has attracted new paying users is by continuing to build out its product offering. From adding more cryptos like Cardano, its acquisition of FairX to get into derivatives of certain cryptos, and expanding its wallet capabilities, to even launching an NFT marketplace to compete with OpenSea, the company has certainly been busy. As crypto continues to get crushed and a lot of major institutional traders get wiped out along with a lot of retail traders, I do expect Coinbase's volume to shrink and its overall revenue to decline. However, given that crypto has gone through several of these cycles while Coinbase was in business, I expect it to weather this storm as well, and continue to build out its platform further. That's sort of why I like Coinbase as an idea. It doesn't have much direct exposure to the crypto space, but is in essence the crypto space. It is the major transactor for many of the major cryptos. Right now might be an excellent time to start picking up shares too, as the company's traded alongside Bitcoin's price for the last few months, though the two assets are largely uncorrelated. But before we get too excited and YOLO our life savings into into Coinbase, there are several serious problems you need to consider. I think it's obvious that Coinbase is going to bring in less revenue this year, but the question is, how much less? According to some analyst estimates, it could be nearly 50% less revenue year over year. If that's the case, it is incredibly likely that Coinbase will return to unprofitability and start burning through cash. The question then becomes, can Coinbase be able to survive until the start of the next crypto adoption cycle? This is made more distressing by the fact that the so-called era of easy money is basically over, at least for the foreseeable future. As the Fed continues to raise interest rates and starts to sell off its massive balance sheet, it's unlikely the average individual will have the disposable income to speculate with cryptocurrencies. And really, this will be Coinbase's first real test of its durability as a company. Will it be able to last until rates start to come down and capital becomes more available? Because while Coinbase has an easier method of raising capital in the form of issuing more shares, it's going to need those institutional buyers in order to raise capital and sustain the business. At this point, I'm somewhat doubtful that Coinbase really has the, as Ben Feroldi puts it, anti-fragility factor. On top of that, it seems that Coinbase even knows of the troubling times ahead, since it just announced it's laying off nearly 20% of its staff, and also rescinding all job offers for the foreseeable future. As Coinbase is just the latest in a long line of tech companies to get crushed over the last year, the future looks colder and colder. Another relevant problem is Coinbase's actual exposure to the crypto space. On Twitter in August of last year, the CEO said that Coinbase holds $500 million of actual crypto on its books and is investing 10% of its profits into projects in the space. These holdings have grown to over $1 billion of coins, from USDC to Ethereum and other coins available on its platform. I believe this poses a serious and systemic risk to the company on the whole, especially since this is counted as cash on the books and is otherwise undistinguishable from Coinbase's real assets. And we can't forget about the very real threat of competition either. With FTX mulling an acquisition of Robinhood and a dozen other crypto trading startups popping up, there's now some serious competition. With this newfound competition comes a race to the bottom in terms of fees. While this benefits the end user, it would only serve to further distress Coinbase's platform in terms of profitability. Let's take a moment to look at FTX since it's rapidly expanding. Already one of the largest crypto trading platforms, it plans to offer stock trading on its platform as well. If it did pull the trigger on Robinhood, suddenly FTX would have one of the most built-out crypto platforms on the market. As it stands, FTX offers much of the same trading experience as Coinbase, while Robinhood boasts a lot of the smaller features that makes Coinbase's platform so compelling. From wallets to NFTs and seamless payment options, the combination could prove just deadly to Coinbase. I think another big risk that's not being discounted by investors is the actual management of the company. And no, I'm not trying to call out the CEO, however, I just want to acknowledge some of the unfortunate decisions he's made. And most of this comes from his actions on Twitter, so take that as you will. In early 2020, he talked about a company-wide rule that no one is to talk politics, only to seemingly defy his own rule just days later and post about politics during work hours. In more recent news, he again got on Twitter to make a thread specifically about a petition to remove himself as CEO. He stated that his employees were welcome to leave and find somewhere else to work if they weren't happy. These actions, along with others, remind me very much of the Elon Musk School of Business Management. That is to say, not very good. However, I'll leave that up to you to decide if this kind of behavior is befitting of a man who leads a multi-billion-dollar multinational corporation. But with all that said, I do believe that Coinbase is an excellent way for investors to get exposure into the crypto space, especially if you believe that crypto is the future of finance or has some future in finance. Also, if you believe that Coinbase can weather the severe blizzard it believes is coming and can still manage to compete with the several other surging cryptocurrency trading platforms in both innovation and overall product offering. So that leaves us with the question, am I buying Coinbase? And the answer is a resounding no. Though I don't personally believe the crypto space will ever have a significant impact on the future of finance, I also don't think Coinbase is much of a good company either. The best thing that can happen is for Coinbase to look for a buyer, maybe in a larger financial institution that believes in the future of crypto. In the end, I have a very hard time valuing the company because of the crypto space's uncertainty. My price target is between $20 and $25 per share, and that's on the high end. But in reality, I don't see Coinbase having a very good time over the next few months, let alone years. But I'd love to hear your thoughts on Coinbase and the crypto winter down in the comments below. And if you enjoyed this video, I'll bet you'll like the one popping up on screen now. But that's all I've got for you in this video. Until next time, I'll see all of you in the next episode of Dollars and Cents.